Hello, everyone. Welcome back to How to Trade. I'm Shane Vernier, and this is Fomc Live. Today, we're going to be watching Jay Powell take center stage for the first time since the U.S. election. It's going to be a fascinating engagement. Here is the headline right now. Federal Reserve cuts interest rates by a quarter point. Now, we all knew that this was going to happen. There was a 99% chance that we were going to get a quarter point rate cut today. But what we really got to really focus on is it's all about the forward guidance. I mean, it's all about the forward guidance. You can see sort of the roller coaster ride we've been on going back to 2002. That was a long time ago. I was there. So were some of you. And then we saw the big rally in these interest rates and then the big bubble pop, bubble pop back in 2008. And this was an absolute catastrophe for the world of finance. And then we really went to 0% until we got into 2016, started raising those rates. And then what happens now? Well, we're up at around 4.5 to 4.75. And you can see right there was the rate cut. So the rate cut was a big deal today. It's sort of sending things a little bit chaotic, I would say. It was on the heels of a BOE rate cut. So we've got a lot going on in the world of global finance. This is the chart to look at, and everybody in the world is trying to figure out what the Fed's likely to do, not really now or not next month, but what they're thinking about doing next year. Been a lot of talk about the Trump doctrine where we're looking at maybe tariffs. Things like tariffs are almost guaranteed. You're going to see potentially a new phase in the trade war with China, and everybody's really worried that that's going to drive inflation, but it may not necessarily be so. We didn't see inflation throughout Trump's first term, and there was a lot of those trade wars in place. So I'm watching around. I'm looking around. I'm seeing some of these headlines, like right here, what changed? This is always a nice feature. CNBC, I don't really care for their reporting, but they do outline a few things. Recent indicators suggest that economic activity has continued to expand at a solid pace. Since earlier this year, labor market conditions have slowed or generally eased. You guys see what I'm saying here. Basically, they're saying we're on the right track and we're on pace to get down near that 2% inflation, something like that. Dre Day every day. Good to see you. Martin 174, Arshad Khan. Good stuff, guys. Glad to see everybody. Dibble, Bren, Mark Corp. The more things change, the more they stay the same. And the bottom line is this. The Fed's holding the line. They say they're on the right track. They say that they're going to deliver 2% inflation and solid economic growth. That's going to be a bit of a different path, I think, now that we're going to be talking about tariffs right away. We're going to be talking about media coverage that's not necessarily going to be as positive towards inflation. Don't ever underestimate that. Now, inflation is going to become a major problem again. Now, you and I both know that it's never left. It's never left the equation. I mean, when we're talking about inflation, we're talking about trying to get down to 2%. We're nowhere near 2%. The Fed knows that. So the idea here that we're going to cut rates is we're going to support the jobs market, which is flailing. There's no two ways about it. It's flailing right now. We're going to have to boost the jobs market, and we're going to have to boost economic growth. Now, the real question is, how long does the Fed stick with this? And Jay Powell's going to talk about what they project to do by the end of the year. That dot plot in the projections, all of that is the most important thing. We knew a quarter point was coming. Our market reactions right now, we're not really seeing anything here. We're seeing a little bit of a give back in the Dow from yesterday's monster rally. We're seeing the S&P sort of up about a safe 0.5%. The NASDAQ has absolutely exploded on the back of Tesla. Tesla right here. This is a tweet I put out earlier today, but you'll look right there. I mean, you're trading back in August 2022's range. This is a very important supply zone, and it's no accident that you see something like a Tesla absolutely explode. Okay, we expect Musk to be in pretty good shape regulatory-wise under the Trump administration. That drove a tremendous amount of bids to Tesla. So where's Tesla right now? It goes to 300 and then it stops. Markets have memories. There's no question about it. So if you bought Tesla yesterday, fantastic. Good for you. You're long. That's not the end of the road for Tesla. I can tell you this. You'll see a Tesla 400. No question about it. But right now, this is an area where I would expect a short-term pullback. So let's say you want to buy Tesla, but you feel like you missed out. Just wait. These markets are going to come back down a little bit, and they'll give you a chance to go long. I'm still very skeptical about the long side of the stock market right now. I think we saw a lot of euphoric buying yesterday. There's no question about it when you pull a chart like this, what exactly is happening. I mean, that's the Dow Jones Industrial, the weekly. What are they up on the week? 4%. I mean, that's huge. I mean, take a look at that big green bar right there compared to the rest of everything. I mean, it's a huge weekly gain. It's probably the biggest weekly gain since we went back there to October of 2023. This is massive. So it's election-driven. It's euphoric. Now, it's not that I believe that we're just going to stop and sell off at the drop of a hat. But what I do think is going to happen is The bidders are going to get tired, and they're going to get tired relatively soon. Natural resistance is up there at 45,000. That's where we're going. I think that's exactly where we're going. S&P 500, we're right at 6,000. I drew these charts a long time ago, guys. This isn't an accident. We're going to 6,000 right up in here. I'll start to build a short idea in my mind because I do believe we get a retracement. But the landslide, the degree of the Trump victory is really something that caught the markets by surprise. They expected a close election, and it was not close. Bobby Bob, good to see you. Jeanette, always a pleasure, Jeanette. Glad you guys can join me live. Let me see Clive Harrison. How you doing, Shane, a.k.a. Metro from the UK? Right on. Might become a Trump supporter. Went in for a quick DGI trade yesterday. One hell of a ride. Well, I'll tell you what, Clive, if you got on the long side of those stock markets yesterday, if any of you did, congratulations. Well done. For me, I told you guys on Monday, I'm sitting on my hands this week. A lot of everybody says, God hates a coward. Believe me, I see a lot going on in here that is, I think we're going to have some great trading. I think we're going to have some massive great trading between now and Thanksgiving. I really do. We just got to wait. I think the next 2 weeks are going to be absolute dynamite. Remember, every dollar that you lose, you have to make back to be long-term profitable. And that's what this is all about. It's about profitability and really what we want to get accomplished with our careers in the market over the long run. All right, 5 minutes to D-Day when Jay Powell takes center stage. I'm curious to see what color tie he's going to wear. I think I'm really curious. Remember, Red's Republican, Blue's Democrat. Jay's been wearing purple ties. Absolutely fascinating stuff. I love the little things. The little things make you happy in this world. In any case, trade follow-up. I do want to hit this one pretty well. Now, remember, let me see. What are my thoughts on oil, Cam? Yeah, we could pull an oil chart. Why not? I'm still incredibly bearish, but you're seeing a big run-up today. I think that the market really, really collapses, the oil market. We'll look at the oil next. I want to do a quick trade follow-up, though. The BOC slashes rates. This was something I put out 2 weeks ago, 11 days ago, something like that. It's basically a sell from a triple top. And, it was pretty good. It was pretty good. We went right up there to that monthly double top. It's now a monthly triple top. This is a good look at your weekly chart. And we're going to attack the dollar CAD again today. But what I'm looking at right now is just an absolutely fantastic trade. Perfect. Called that thing perfect right there. We even hit that one again. Remember, markets have memories. You see something like a monthly triple top right around a big round number, something like 140. You have an incredible opportunity to make trades. And those kind of trades are really good on the Forex because there's so much depth. We just went over that Tesla stock. We know 300 is a big deal. Everybody in the market knows 300 is a big deal. And when we look at market calls like that, makes me smile, makes me happy. That was a relative layup for 40 pips. A lot of traders would say, Shane, you got to get me more than 40 pips. And I say, I'm from the old school. I get what I'm going to get front and center. I don't play around. I pile the leverage on, and if I'm right, I'm right. And if I'm wrong, I cut it off. That's how I trade. It doesn't mean that's how you have to trade, though. Low leverage plays, trying to get bigger moves, man, there's nothing wrong with that. There's nothing wrong with that at all. So I do really want to stress, though, I was happy with the way that trade performed. Some of them go right. Most of them go right. Some of them go wrong. And we had sort of a real challenging gold trade a little bit earlier. But this ties into the oil question. What do we want to do here? I'm buying pullbacks 137.51. If, in fact, the USD gives back some of its puff right here and the Canadian dollar comes down a little bit, I think that's a fantastic dip. That's a fantastic dip to buy, so I'm going to be watching that closely in the dollar CAD. As far as U.S. oil goes, let's go ahead and hit this. My market read was relatively simple. Our weekly chart really illustrates the bottom of this market, which is right down there at right around 64. My big number was 64.70, but 65 is big. As far as what do we want to do right now with U.S. oil, we had a pretty good scalp trade yesterday in the futures market. It missed its entry by about 2 ticks. This is a textbook trend day up. Right here, opening bell ding ding about 9 a.m. Eastern. That's when the traditional NYMEX pit opens, and now we're rolling and rallying. If I'm trading WTI crude, I do one of two things. I'm either looking to scalp from 38% to get with this. You could definitely go the most current spike to spike or just that U.S. session. That's absolutely huge. If you wanted to go current spike to spike, you could. I would probably go right around that U.S. session. I love both of those numbers are right above 72. So if you wanted to scalp right now, you're at 72.33 when Jay Powell starts speaking. 72 buys, 72.05 buys. I'm into that. I'll give you that. That's not bad at all. But if you are interested in taking a position, I would be very careful holding longs here. If you want to hit it for 5 or 10 ticks, go ahead and get to it. But I don't recommend holding this thing for the near future. I think that could be a real bad idea. I think this market falls away in a big, big way. But right now, if I was day trading U.S. oil, that's what I would be doing. buying pullbacks from there. And if you wanted to wait, 71.50, that's even better. That's even better. So I'd be looking at that very closely. Let's hit gold here. We got T minus 47 seconds, and then we'll run a quick audio test. Gold was a challenge, guys. I'm not going to sit here and lie to you. I thought the U.S. election was going to be the biggest market driver we've seen in a long time for gold, and you had two ways to go, up or down. I know, Mr. Obvious, right? Well, here's the deal. Trump won, but it wasn't about that he won. It was about how big the victory was and carrying the Senate. And it looks like they're going to carry the House. You're going to have Republican control of all three facets of Congress. That's a big deal, and that's why you saw gold correct, because we weren't necessarily sure how that was going to impact, number one, geopolitical stability, what it was going to do to the dollar. A lot going on in this gold trade. However, we did throw a few entries out there. 38% didn't work. 62% didn't work. Called the bottom down there at 78, though. So that was an interesting call there. Okay, guys, let's go ahead and check this out. I'm going to go ahead and see if I can get the audio up and rolling. Should be able to. Just 1 minute. Okay, I just heard the music just a minute ago, but I think as soon as Jay comes out, just give me a quick thumbs up or thumbs down when you can hear it, when he starts talking. That should really line us up for what we need to do here today. I mean, I can hear it. You should be able to hear it too. As soon as he starts talking. Just a quick thumbs up in the live chat.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The economy is strong overall and has made significant progress toward our goals over the past 2 years. The labor market has cooled from its formerly overheated state and remains solid. Inflation has eased substantially from a peak of 7%
Good to go.
to
Thank you, Brent. Thank you,
2.1%
Raines.
as of September.
Appreciate it.
We are committed to maintaining our economy's strength by supporting maximum employment and returning inflation to our 2% goal. Today, the FOMC decided to take another step in reducing the degree of policy restraint by lowering our policy interest rate by a 1/4 percentage point. We continue to be confident that with an appropriate recalibration of our policy stance, strength in the economy and the labor market can be maintained, with inflation moving sustainably down to 2%. We also decided to continue to reduce our securities holdings. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. GDP rose at an annual rate of 2.8% in the third quarter, about the same pace as in the second quarter. Growth of consumer spending has remained resilient, and investment in equipment and intangibles has strengthened. In contrast, activity in the housing sector has been weak. Overall, improving supply conditions have supported the strong performance of the U.S. economy over the past year. In the labor market, conditions remain solid. Payroll job gains have slowed from earlier in the year, averaging 104,000 per month over the past 3 months. This figure would have been somewhat higher were it not for the effects of labor strikes and hurricanes on employment in October. Regarding the hurricanes, let me extend our sympathies to all the families, businesses, and communities who have been harmed by these devastating storms. The unemployment rate is notably higher than it was a year ago, but it has edged down over the past 3 months and remains low at 4.1% in October. Nominal wage growth has eased over the past year, and the jobs-to-workers gap has narrowed. Overall, a broad set of indicators suggest that conditions in the labor market are now less tight than just before the pandemic in 2019. The labor market is not a source of significant inflationary pressures. Inflation has eased significantly over the past 2 years. Total PCE prices rose 2.1% over the 12 months ending in September, excluding the volatile food and energy categories. Core PCE prices rose 2.7%. Overall, inflation has moved much closer to our 2% longer run goal, but core inflation remains somewhat elevated. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. We see the risks to achieving our employment and inflation goals as being roughly in balance, and we're attentive to the risks to both sides of our mandate. At today's meeting, the committee decided to lower the target range for the federal funds rate by a 1/4 percentage point to 4.5% to 4.75%. This further recalibration of our policy stance will help maintain the strength of the economy and the labor market, and will continue to enable further progress on inflation as we move toward a more neutral stance over time. We know that reducing policy restraint too quickly could hinder progress on inflation. At the same time, reducing policy restraint too slowly could unduly weaken economic activity and employment. In considering additional adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. We are not on any preset course. We will continue to make our decisions meeting by meeting.
Of course, Jerry, of course.
As the economy evolves, monetary policy will adjust in order to best promote our maximum employment and price stability goals. If the economy remains strong and inflation is not sustainably moving toward 2%, we can dial back policy restraint more slowly. If the labor market were to weaken unexpectedly, or inflation were to fall more quickly than anticipated, we can move more quickly. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to our discussion.
He's got the purple tie, apolitical. Those storms, the hurricanes, are still being the scapegoat for everything, especially that last jobs number.
The election outcome will
They
produce
know it's
policies
low.
that
They know
will
it's real
meaningfully
low.
impact the U.S. economy next year. How is the committee taking these proposals into account for upcoming decisions, including potentially the next one in December? And can you give us any more sense of how proactive or reactive the Fed is prepared to be to changes in economic policies with the next administration?
130.65 in the pound.
Sure. So let me say that in the near term, the election will have no effects on our policy decisions. As you know, many things affect the economy, and anyone who writes down forecasts in their job will tell you that the economy is quite difficult to forecast looking out past the very near term. Here, we don't know what the timing and substance of any policy changes will be. We therefore don't know what the effects on the economy would be, specifically whether and to what extent those policies would matter for the achievement of our goal variables, maximum employment and price stability. We don't guess, we don't speculate, and we don't assume. Now, just in principle, it's possible that any administration's policies or policies put in place by Congress could have economic effects that over time that would matter for our pursuit of our dual mandate goals. So we, along with countless other factors, forecasts of those economic effects would be included in our models of the economy and would be taken into account through that channel.
Okay, so they're dialing back the rate cut expectations already due to the new administration. That's what he just said.
Chair Powell, Nick Timmerman.
He said we don't know what we're going to do, but it could impact us.
Roughly 1 year ago, when the 10-year Treasury was flirting with 5% and
That's
30-year
big.
mortgage rates were near 8%, you noted how higher borrowing costs, if they were sustained, could weigh on economic activity. Given that you've said you believe policy is restrictive and the Fed is now dialing back that restriction, are the growth risks presented by higher U.S. Treasury yields today any different from those you identified 1 year ago when inflation was still meaningfully above your target?
Dollar getting spanked. It's getting spanked.
I would just say this: we've watched the run up in bond rates, and it's nowhere near where it was, of course, a year ago. I guess the long run rates are well below that level. So we're watching that. Things have been moving around, and we'll see where they settle. I think it's too early to really say where they settle. Ultimately, I'm sure we've all read these decompositions of what, and I certainly have, but it's not really our job to provide our specific decomposition. I will say, though, that it appears that the moves are not principally about higher inflation expectations. They're really about a sense of more likelihood of stronger growth and perhaps less in the way of downside risks. So that's what they're about. We do take financial conditions into account if they're persistent and if they're material. Then we'll certainly take them into account in our policy. But I would say we're not at that stage right now. It's just something that we're watching. And again, these things don't really have mainly to do with Fed policy, but to do with other factors in the economy.
If I could follow up, is the September SEP, are those rate projections still valid? Do they still seem relevant given where we are now?
You get halfway through the cycle between the last set and the next set. I wouldn't want to comment one way or the other. Let's talk about the data we've gotten since the last meeting. So in the main, the economic activity data have been stronger than expected. The NIPA revision was stronger. Certainly the September employment report was stronger. The October report, not stronger. Retail sales stronger. So overall, though, I think you take away a sense of some of the downside risks to economic activity having been diminished with the NIPA revisions in particular. And so overall feeling good about economic activity. So I think we would factor that in. At the same time, we got one inflation report, which it wasn't terrible, but it was a little higher than expected.
Yeah, it
so
was.
I think really the question is December, and by December we'll have more data. I guess one more employment report, two more inflation
He's tempering
reports,
expectations right
data,
now
and, we'll make a decision
about the rate cuts.
as we get to December.
Supposed to come off another half point this year. That was what the dot plot in September said. He's backing off of that because there's a new administration. There's a new sheriff in town. They're backing off of that. They're not going to cut like they said they were going to cut.
What will you be looking at specifically as you try to make that decision? And then as of the Fed's economic projections in September, you had written down 4 quarter-point interest rate cuts in 2025. Do you still think that those are likely? Is that sort of the baseline outlook at this point, or has that shifted? And if it shifted at all, can you give a little bit of detail as to why?
I can't. We don't fill out an SEP, and I can't characterize one that wasn't filled out today. So I can't really speak for kind of exactly where the committee is. I will just say for December we're going to be, again, at every meeting we're going to be looking at the incoming data and how that affects the outlook. As you know, we're in the process of recalibrating from a fairly restrictive level at 5.33%. After today's move, we're down 75 basis points. And we're asking ourselves, is that where we need to be? That we're trying to steer between the risk of moving too quickly and perhaps undermining our progress on inflation, or moving too slowly.
Yeah, I mean, this is a different tone. This is a completely different Jay Powell right now. Completely different. Elections matter, believe me.
Can maintain
that's
strength in the labor
unreal,
market
his
while
tone
also
now.
enabling further progress on inflation. We think that's where we are, but that's the question we're going to be asking in September. And in other meetings. And again,
what do you mean in September? It's November, partner.
Thinking, because we don't fill out an SEP at this meeting.
Yeah, totally appreciate that. I guess when it comes to your own thinking, do you think that a full percentage point of rate cuts in 2025 is a reasonable outlook?
Again, I'm going to wait. We're going to wait and see how things.
They're backing off
in
of it.
December. I mean,
they're backing off of it.
It's just. I would put it this way: we're on a path to a more neutral stance. And that's very much what we're on. That has not changed at all since September. We're just going to have to see where the data lead us. We have
this is a tough trade right here. You got to get in out of this one fast.
To make that decision in December. Obviously, I'm not ruling it out or in, but I would say
right there at 90.51.
I would say that.
No fill.
Again,
we hit that
didn't
perfect.
update
No
the
fill.
SEP, so I'm not going to characterize where the committee would be.
Howard.
Thanks, Howard Schneider with Reuters. I wondered if you could please elaborate, explain a little bit the 2 changes in the language of the statement here. In the first paragraph, when you say inflation has made progress, dropping the word further progress. And in the second paragraph, dropping the sentence that the committee had gained greater confidence that inflation was progressing towards its 2% goal. Is there any policy substance behind either of those changes in language? Is it meant to open the door to a December pause? Is it meant to communicate anything about the stickiness of core inflation the last 3 months?
Not really, no. So let me tell you what we were thinking. So
Tell
the
us,
test
Jay.
of
Come on, Jay. Tell us.
gaining further confidence was our test for the first rate cut, right? And so we met that test in September, and therefore we take that test out. If you leave it in, then it's new forward guidance. It's brand new forward guidance. What do you mean by it? Are you requiring yet further? We have to say yes or no at every meeting whether we've made further progress. The point is we have gained confidence that we're on a sustainable path down to 2%. So that I would tell you is what that's really all about. It's not meant to send a signal. Neither of those is meant to send a further signal.
E-mini
And
S&P
saying further
500
progress,
futures.
it becomes a test. We don't want to be.
That is
we don't
ugly.
think it's a good time to be doing a
That's
lot
ugly.
of forward guidance. You know, there's a fair amount of uncertainty in what I've said. The path that we're on, we do know where the destination is, but we don't know the right pace, and we don't know exactly where the destination is. So the
Look
point
at
is to
that.
find that.
Look at
To
that.
find the right pace and the right destination as we go.
Good to see you,
And
Hikmet.
I think there's a fair amount of uncertainty about that, and you don't want to tie yourself up with guidance. You want to be able to make sensible decisions as you go.
That's a megaphone formation. Nobody knows what the heck's
Steve
going on
Leisman,
right
CNBC.
now.
Mr. Chairman, you talked about higher rates.
Tough
perhaps from
trading,
an
guys.
expectation of higher growth. You didn't talk about it in terms of expectations of higher deficits. Is that something you think might be behind the recent rise in interest
Good
rates?
trade
And is
there.
that, are rising
Don't trade
deficits a
1 minute
concern to
levels
you?
twice. Forget that.
So we don't comment on fiscal policy, and again, I don't have a lot more to say on what's driving bond yields. In terms of policy changes, though, let me give you a sense of how this works in the ordinary case. Let's say Congress is considering a rewrite of the tax laws. Doesn't matter
He's
what's in the
talking
the
politics
content.
now.
So
This is a
we
market
would follow
mover. Be
that.
careful.
At a certain point, we'd think we see the outline, so we'd start to model it. And then we'd wait, and then at a certain point, the staff would brief the FOMC and say, these are the likely effects. There's lots and lots of literature on the effects of tax policy changes on various parts of the economy. So we'd try to get smart on that, and then the law actually passes. And you'd start to put it. You'd probably run an alternative simulation before that happens, just to keep people trying to understand it. Then when it actually passes, it goes into the model, along with a million other things. So, we have a very large
They're gonna
economy.
pause
Many
rate
things
cuts.
are affecting
It's
it
clear
at
as
any given
day.
time. And
Clear
a
as
law
day.
change of some kind would go in there, but it would go in. But it would, it's a process that takes some time. Clearly, the legislative process takes a lot of time. And of course, the real question is not the effect of that law. It's all of the policy changes that are happening. What's the net effect? And the overall effect on the economy at any given time. So I think that's a process that takes a lot of time and that we go through all the time with every administration, constantly. And this will be no different. But right now there's nothing to model right now. It's such an early stage. We don't know what the policies are, and once we know what they are, we won't have a sense of when they'll be implemented or all those sorts of things. So I think I would just say we're not doing that now, and all that will take time, and it will be very much regular order when we do that.
If I could just follow up on Nick's question. Are the current rates something you feel like you need to lean against in that they go against the direction of policy by adding restriction to the economy, or do you just take them as a given and perhaps a signal that you should do less?
This will be interesting right up here.
The first question is
97
how long will they be
cells.
sustained? If you remember the 5% 10-year, people were drawing massively important conclusions, only to find 3 weeks later the 10-year was 50 basis points lower. So it's material changes in financial conditions that last, that are persistent, that really matter, and we don't know that about these. What we've seen so far,
Just whipsaw
we're
action
watching
here.
it, we're reading, we're doing the decompositions and reading others, but right now it's not a major factor in how we're thinking about things.
Chris.
Got topside resistance up here at
Thank you, Chris Rugaber at
26.97 in
Associated
gold.
Press.
We're going to try a scalp.
You mentioned the positive economic data that we've seen since the September meeting, including the revisions to things like savings, higher GDP growth. We saw stock market jump yesterday. That's renewed some of the questions about why do many cuts at all in this with this backdrop.
Good question.
So you're right. As I mentioned, and as you mentioned, the latest economic data have been strong, and that's, of course, a great thing and highly welcome. But, of course, our mandate is maximum employment and price stability, and we think that even with today's cut, policy is still restrictive. We understand it's not possible to say precisely how restrictive, but we feel that it is still restrictive. And if you look at our goal variables, the labor market has cooled a great deal from its overheated state of 2 years ago and is now essentially in balance.
Okay.
It is continuing to cool, albeit at a modest rate.
It's in balance.
And we don't need further cooling, we don't think, to achieve our inflation mandate. So that's the labor market. Inflation has moved down a great deal from its highs of 2 years ago.
Go to the
And
supermarket.
we judged,
Come on.
as I
How can you
mentioned,
say
on a
that? It's
sustainable
entrenched
path
and you know
back
it.
to 2%.
Can't
so the
say
job's
that.
not done on inflation. But if you look at those two things,
No, the job isn't done.
we judged in September that it was appropriate to begin to recalibrate our policy stance to reflect this progress, and today's decision is really another step in that process. Overall, as I mentioned, we believe that with an appropriate recalibration of our policy stance, we can maintain strength in the labor market even as our policy stance enables further progress toward our inflation goal.
Great.
So we're
And
looking
just
to
to follow
sell
up, can you-
26.97
What might
here.
cause you to pause rate cuts
I'm only looking for a
in
pullback
December?
right
What kind
around
of economic
95-ish
data
or
would
so,
lead you to
96.
that,
This is going to be a
path?
short trade.
Thank you.
You don't want to hold
So,
this if it breaks out to the top side.
We haven't, made any decision like that at all. But we're in the process, as I mentioned, of moving policy down, our stance down over time to more neutral level. And as a general matter, as we move ahead, we are prepared to adjust our assessments of the appropriate pace and destination as the outlook evolves. So, for example, if we were to see the labor market deteriorating, we'd be prepared to move more quickly. Alternatively, as we approach levels that are plausibly neutral or close to neutral, it may turn out to be appropriate to slow the pace at which we're dialing back restriction. Again, haven't made any decisions about that, but that's certainly a possibility. If you can think of it as similar to what we do with asset with asset runoff, with QT. So we reach a point where we slow the pace, much like an airplane reaching the airport slows down. And so we're thinking about it that way, but it's something that we're just beginning to think about.
Edward.
Thanks, Chair Powell. So with the noise in the jobs reports that we've seen, and you look at the Fed's favorite inflation, PCE inflation, overall it's 2.1%, very close to the Fed's target, but core inflation is 2.7%, and it's been that way since July. So why doesn't this data give fuel to a rate pause for this meeting?
Well, so I think if you look at the 3 and 6 month, you're quoting the 12-month. So we look at all of them, right? But if you look at 3 and 6 month core PCE, you'll see they're around 2.3%. So we
Still
look at
working
all
a
of
buy
them,
here. We'll
and
see.
we look at 12 as well.
Got to get a
But
crossover.
what it's telling us is that we really have made significant progress, and we expect there to be bumps. For example, the last 3 months of last year, the core PCE readings were very, very low, probably unsustainably low. So that's why forecasts generally see
Going
a couple of
bullish again
upticks
here.
toward the end of the year. On the other hand, the January reading certainly looks like an example of residual seasonality, so that we saw last year. So when that falls out of the 12-month calculation in February, we should see a thing down. So it'll literally
This is really
be a
hard
bump
to
up
trade,
and
this
then
kind of
down.
chart pattern.
We understand that.
Really
Overall,
hard.
You see the progress on inflation, and you also look at the economy and you say, what is the inflation story now? Where's it coming from? So I point to a couple of things. One is the non-housing services and goods, which together make up 80% of the core PCE index, are back to the levels they were at the last time we had sustained 2% inflation, which happens to be in the early 2000s for a period of 5, 6, 7 years. So they're back to that level. What's not is housing services. So let's talk about housing services. Housing services is higher, what's
That's a
going on
flat
there
market
is,
right there on a 5 minute.
market
Yeah,
rents,
that's really
newly
tough.
signed leases are experiencing very low inflation.
E-mini
And
S&P
what's happening
500
is
futures.
older, leases that are turning over are taking several years to catch up to where market leases are, market rent leases are. So that's just a catch-up problem. It's not really reflecting current inflationary pressures. It's reflecting past inflationary pressures. So that's one thing. The other thing is I'd say look at the labor market, not a source of inflationary pressures. Where's it coming from? It's not a very tight economy. What is the story about inflation? You see that catch-up inflation also in insurance and several other areas. So you're seeing, we're not declaring victory, obviously, but we feel like the story is very consistent with inflation continuing to come down on a bumpy path over the next couple of years and settling
trying
around
to get a
2%.
trade here.
That story is intact, and it won't be one or two really good data months or bad data months aren't going to really change the pattern at this point now that we're this far into the process.
So you're quickly trying to get to that neutral rate that you see, or do you foresee that you have
Really
some time to
tight,
get there?
really
Nothing
tight.
in the economic data suggests that the committee has any need to be in a hurry to get there. We are seeing strong economic activity. We are seeing ongoing strength in the labor market. We're watching that
There's
carefully.
the crossover.
But we do see
probably the next
maintaining
5 minutes or
strength
so.
there. And so we think that the right way to
Chop
find
City.
neutral, if you will, is carefully, patiently. Again, that's not meant to have a specific meaning, other than to the extent the economy remains strong, we have the ability to take advantage of that as we try to navigate that middle path between the two risks.
Craig.
Might
Hi,
get to
Chair
sell
Powell.
finally.
Craig Torres from Bloomberg. 2 questions today.
Hi, Craig. How you
did
doing?
you learn anything about what Americans think about the economy from the election results?
Yeah, there it
First
is.
question. Second question. I want to talk about some labor market indicators, and I do so with great respect for your attentiveness to the maximum employment side of the mandate, Chair Powell. So the unemployment rate has been at 4% or higher for 6 months. One of the broadest measures of unemployment is up about a half a point from a year ago. Compensation gains are sliding back. The quits rate, a signal of labor market dynamism, has been heading down to that bad neighborhood of the 20 teens. So you have put a marker at Jackson Hole saying any further cooling is unwelcome. It is cooling generally a little bit further. So at what point do we reach what you would describe as a shortfall from maximum employment? Thank you.
Sure. So on your first question, I'm not going to talk about anything that relates directly or indirectly to the election. On the second one, this is the great question, and it's the one we think about all the time. So I'll just say a couple things. There's nothing really surprising here. What we know is that the unemployment rate is low. We also know that it's moved up significantly from a year or so ago. So we've seen a big change upward in unemployment. Sometimes that has meant bad things. So far, it doesn't appear to be. It appears that I wouldn't say that the labor market has fully stabilized, because I do think it's continuing to very gradually cool. But it seems to be in a good place, and our policy, of course, is designed to keep it in that good place, to maintain the strength in the labor market, while also enabling further progress on inflation. You mentioned a bunch of indicators, and you're right. The openings to unemployment rate is back to a normal level. I would characterize it more broadly as normalizing. You mentioned wages. Wages are still running just a bit above where they would need to be consistent with 2% inflation, unless productivity is going to remain at this high level. If we see productivity, more sustainably at these high levels, then that would sustain higher wage gains. So I would say, in fact, you can say it the other way, that wage
A lot of
increases
sellers
are
up here
now
around
consistent
95.
with 2% inflation, given current productivity readings. But of course, the lore on productivity readings is whenever you see high readings, you should assume they're going to revert pretty quickly to the longer-term trend. That has always been the case for 50 years. But it may be that we're now 5 years. If you look at the NIPA revisions that came out a month ago, we're 5 years into a nice set of productivity readings, which are sustained and very healthy. But Overall, it's a good labor market. We could talk about 20 different data series. We'll be looking at all of them, of course. We don't want the labor market to soften much from here. We don't think we need that to happen to get inflation back to 2%.
How can he say the numbers from the last 5 years are solid? You had COVID in there. You have to throw the numbers from the last 5 years out with that.
Some of the president's
I don't know, Jay.
advisors have suggested that
This
you
is
should
CYA
resign. If he asked you to leave, would you go?
No.
Can you follow up on, do you think that legally you're not required to leave?
No.
I'm not going anywhere. Next question.
Michael McKee from Bloomberg Radio and Television. You talk
He
a
doesn't
lot,
like Trump very
about,
much.
What the data are telling
guy to
you
work
and how
for.
you are dependent on the data, but in terms of
Would you leave?
forward-looking
No.
assessments of
doing
the
that.
economy, what are you hearing from CEOs or other officials around the country?
Good answer.
What did you hear today from the regional bank presidents about what companies and consumers think about where the economy is going from here rather than looking backwards? And does that match up with what your forecasts
Look
have
at
been
that
and what you
parade.
think the appropriate policy path should be?
So it's hard to characterize a really interesting set of discussions we had, and of course you'll see them in the minutes in 3 weeks. But I would say this: I think the comments from our Reserve Bank colleagues and from the CEOs that they talk to are pretty constructive on the economy right now. Pretty constructive, feeling that the labor market is back to normal, to the point where it's no longer that much a discussion topic in their worlds, whereas 2 years ago it was all they were talking about. So they feel like the labor market's in balance. People feel good about where the economy is. Demand is obviously pretty
Stocks
strong.
broke. They broke
And,
higher.
You're seeing 2.8% growth in the third quarter estimated. Maybe the year's 2.5%. This is a strong economy. It's actually remarkable how well the U.S. economy has been performing with
can't seem to
strong
get that
growth, a strong labor
crossover.
market, inflation.
This is
coming
tough
down.
trading, everybody.
We're
Whipsaw.
really performing better than any of our global peers, and I think that is reflected in what you hear from what I hear people hear from CEOs. I don't get to talk to a
Will
lot
gold
of
climb after
CEOs
today's
in my
FOMC
job,
news right
but
now?
I hear what others
I have no
summarize
idea,
from those, and of course
Pushkar.
I hear the Reserve Bank presidents do a lot of that, and
This is-
it's pretty constructive.
how
overall.
fortunes
Now,
are
that's not
lost
to
right
say
now.
There are areas of caution.
Fortunes
and,
are lost this way. It's too
and things
choppy.
like that, but ultimately,
People are
overall,
long are
pretty
getting hurt.
positive.
People that are short are getting hurt.
To follow
It's
up,
too
the
it's
areas
too
of
hard.
caution, if there were black clouds on the horizon that
I
you
want to sell up
identified
there
as
at
something you're
97 on
watching,
gold and
what
scalp
would they
it.
be?
I want to buy with this
think it's,
breakout right
it's
here.
things like-
I want to buy U.S. oil, but
Clearly,
I'm talking real short terms,
geopolitical risks
real
around
short
the
term
world
stuff.
are elevated, and just as clearly they've had relatively little effect on the U.S. economy. Now, that can change through the price of oil or otherwise.
Our shot. I think
but
Trump hates him more.
people
Hear
talk
that?
about
Price
those
of
as,
oil.
something that's on
He's
the horizon
he's a passive.
all the time.
We'll talk
But,
about it after he's
ultimately,
done.
If you look at the U.S. economy, its performance has been very good, and
All right, there's our sell.
that's what we hear from business people, and expectation that will continue. If anything, people feel next year. I've
Getting
I've
hurt
heard
or
this
there's
from
sellers there?
Several people that next year
We're gonna find out.
could even be stronger than this year.
Andrew.
Break into the bull. Probably have to cut this
Hi,
one off
it's
around
Andrew Ackerman with the
2,700,
Washington
somewhere
Post.
in there.
I just
We're
wanted
looking
to
for a
follow up on the
retracement.
discussion earlier on fiscal policy.
I want to see
Your
something maybe down in
predecessors,
here.
Greenspan
That would be a
and Volcker,
worthwhile play.
Spoke up loudly when they thought large budget deficits endangered financial economic
there's our
or financial
sellers.
stability. Will you
There's
do
our
that
sellers.
too? And right now we're in a period of full employment. We have large budget deficits and debt at historic highs that are and rising. Is that
Bullish
something you
pressure's
speak out
there. Let's wait and
against?
see what
So,
happens here.
I have said many times, no more, no less than what the predecessors you mentioned have said. And what that is that the U.S. federal government's fiscal policy is on an unsustainable path. The level of our debt relative to the economy is not unsustainable. The path is unsustainable. And we see that in, you've got a
So
very
we have
large
to cut
deficit
spending?
you're at full employment, and that's expected to continue. So
Pressure's there.
It's important that we, that to be dealt with. It is ultimately a threat to the economy. Now, I can say that. I don't have oversight. We don't have oversight over fiscal policy. I've said it on many occasions, just
Give
said
this
it
thing
again.
another minute, then we're going to pull the plug
Okay,
on
thank
it.
you. I guess the other question is, to follow up on Victoria's question, do you believe the president has the power to fire or demote you, and has the Fed determined the legality of
You
a
already answered
president
that.
demoting
All right,
at
we're looking
will
at a
any
bullish
of the other
side of this
governors
market.
with leadership positions?
Not permitted under the law.
Not what?
Not permitted under the law.
Thank you.
Courtney.
He's got an attitude about those
Courtney
firing
Brown,
questions, doesn't he?
From Axios. In response to Howard's question, you said it wasn't an ideal
This has
time
gotta be
to
the
give
line in the
forward
sand
guidance
right up
because
here.
of the economic uncertainties. Can you lay out what some of those uncertainties are and whether
Something
or
like
not
that.
it includes some of the proposals that the president-elect has put
Next
out
cell
on
would
the
be
campaign trail?
2710.
Tariffs, for instance.
See what
No,
happens at
I was not
27
referring
here.
to the new administration's policies at all, nor will I today. So what I'm just saying is,
Contentious.
as we look ahead, we know, and I mentioned this in my statement, that the risks are two-sided. I guess I should start by saying that we think that the economy and we think our policy are both in a very good place, And but as you look forward, you say, what are the risks? And one risk is that we would move too quickly and find ourselves having moved too quickly, and inflation comes back, and we lost our chance to get inflation back to 2%. So we have to avoid that risk, and to avoid that risk, that means you want to move carefully.
Few
The other
sellers
risk
at
is that we move too
2700.
slowly, and that
I
we allow
imagine
the
this
labor
this
market
market's
to
going to
weaken
move
too
higher
much
from here.
and do
We took a
unnecessary
shot
damage
on it.
to the
Didn't
labor
give me
market
love,
and to people's
though.
working lives. That says don't get behind the curve. So these two things are the two risks that we have to manage, and so we're in the
Not
middle
dead
there. We
yet.
try to be in the middle and deal
Almost.
with manage both of those. Again, the idea is to support the strength we have in the labor market and in the economy, but also with somewhat less restrictive but still restrictive policy, enable further progress toward our 2% inflation goal. So there's
Breakouts there.
This is a thing we're meeting by meeting. We're going to be making our assessment of what the right path is. It's not as important. The precise timing of these things is not as important as the overall arc of them. And the arc of them is to move from where we are now to a sense of a more neutral policy. We don't know exactly where that is. We only know it by its works. We're pretty sure it's below
See
where
the
we are now.
compression right around
but as we move
2700?
further, there will be more uncertainty about where
Odds
that is.
are this
and we're
thing
gonna
breaks
move
and goes much
carefully,
higher.
as this goes on, so that we can increase the chances that we will get it right.
Simon.
Thank you, Chair Powell. Simon Erminovich with The Economist. I know you don't want to share your decomposition of bond yields, but if you look at the break-evens, it is clear that
sellers
longer-term
up
inflation
there.
expectations do seem to have risen, up at about 2.5%, for example, on the 5-year.
Looks to me like
That's
we're
up
gonna
half a
blow
point
high there. We'll
from
get back
when
to
you
that
cut
in a second.
September. Do you have any concern at all that longer-term inflation expectations
Buying the
are
retracement?
de-anchoring, or put another way, are anchoring at a slightly higher level? Thanks.
So we would be concerned if we thought we saw longer-term inflation expectations anchoring at a higher level. That's not what we're seeing. We're still seeing, between surveys and market readings, broadly consistent with, I looked at the 5-year earlier today, and it's probably moved, but it's just not, it's kind of right where it's been, and also it's pretty close to consistent with 2% PCE inflation. So that's been a traditional one that we look at a lot. But overall, expectations seem to be, and really have throughout this, in a place that's consistent with 2% inflation. But you're right to say we watch that very carefully, and we will not allow inflation expectations to drift upward. But that's really why we reacted so sharply back in
27.35. Cut it.
2022 was to avoid that.
Kelly.
Got to let these things work a little bit. This thing's going
Hi, Chair
higher.
Powell, Kelly
Gold's
O'Grady,
going
CBS
higher.
News. We just talked about what you've heard from
I look the
business
scalp to the
leaders
short
on the
up here at
economy.
27.10.
But many average
There's your
Americans
break.
are still not feeling the strength of
You
the
don't wanna
economy
be around
in their
now.
wallets. So what's your message
We
to
fought our
them
fight,
on when
got
they
hit.
might expect relief?
Get out.
So
I know it sucks,
you're
but
right
that's
that,
life.
we say the economy's performing
Right there was
well,
our
and it
stop,
is,
somewhere
but
right
we
in
also
there.
know that people are still feeling the effects of high prices, for example, and the world went through a global inflation shock, and inflation went up everywhere, and it stays with you because the price level doesn't come back down. So what that takes
There's our crossover.
It takes some years of real wage gains for people to feel better. And that's what we're trying to create, and I think we're well on the road to creating that. Inflation has come way down. The economy is still strong here. Wages are moving up, but at a sustainable level. So it's just I think what needs to happen is happening, and for the most part has happened. But it'll be some time before people regain their confidence and feel that. And we don't tell people how to.
I'll do the
feel about
analysis of
economy.
gold
We
after he's
respect,
done.
Completely respect.
We'll talk
what they're
about where it's
feeling.
going
Those
in the near
feelings are
term.
True, they're accurate. We don't question them. We respect them.
And just a quick follow-up, President-elect Trump has been critical of your performance. Any concern about his influence on the Fed's independence?
No.
I'm not going to get into any of the political things here today, but thank you.
Nancy. Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace.
Do we get the crossover?
What is your plan if we start to see stagflation?
Well, so
Good
that's
question. Good question.
The whole plan is not to have stagflation, so we don't have to deal with it. So that is actually our plan.
There's the cross.
It's of course
Right
a very
there.
difficult thing because you're
Oversold. We're looking for a crossover. See how this high
anything
this
you
thing
do with
goes.
interest rates will hurt one side or the other, either the inflation
9
mandate
EMA
or the-
crossover,
or the,
920 crossover.
or the employment mandate. I would just say that we've been able to see inflation
This
come
is going
down
higher.
a whole lot, much closer to our goal, without the kind of sharp increase in unemployment that has often accompanied programs of disinflation. So, knock on wood, we've gotten this far without seeing a real weakening in the labor market, and we believe we can complete the inflation task while also keeping the labor market strong, and that, of course, is exactly what we're trying to do.
Can you rule out an interest rate hike next year?
No, I wouldn't rule anything out or in that far away, but that's certainly not our plan. I mean, our baseline expectation is that we'll continue to move gradually down towards neutral, that the economy will continue to grow at a healthy clip, and that the labor market will remain strong. If you look at our that will not change from the September SEP. That is our baseline forecast, and short of some exogenous event, that will continue to be our forecast for the foreseeable future. So. But ultimately, we're not in a world where we can afford to rule things out a full year in advance. There's just too much uncertainty in what we do.
Let's go to Jean for the last question.
The last question. Thank goodness.
Hi, Chair Powell. Jean Young with MNI Market News. I wanted to go back to a comment that you had made about Americans being quite unhappy about the cumulative price level rises over the past few years, even though now inflation is back on a path to 2%. Would it be appropriate for the Fed to undershoot for a while on its inflation goal under the average inflation targeting regime so people have a chance to catch up?
Good question.
No, that's
Smart.
not the way our framework works. We're aiming for inflation at 2%. We did not think it would be appropriate to deliberately undershoot.
Stock's going higher.
And part of the problem there is that low inflation.
Crude
can be a
oil
problem
should get this
too,
buy right here.
in a way, but that's not part of our framework, and it's not something we're going to be looking at in our framework review. Thank you very much.
All right, everybody, we got a few things to go over here. As far as no, not that one, wrong button. As far as Jay Powell goes, what we saw today was. Hang on, here we go. What we saw today was really a Federal Reserve chair saying, listen, our policy's working. We've got employment in a good place. We've got the economy in a good place. We've got inflation coming down to where we want it. And now we're going into that new regime, and we just don't know what we're going to do. It could upset the apple cart. When he started talking about tariffs and he started talking about tax cuts, immediately there was a talk in there about tax cuts. They know that there's probably tax cuts coming. They know there's probably tariffs coming. And he basically said that those things will impact our policy. So if we start to really get in the tall grass about today's, I thought it was a standoffish engagement. I thought that the direct answers, you could see Powell was not very happy about asking if he was going to step down or be terminated. There's no question about that. So we're going into a situation where the government, by and large, aside from a few senators, essentially left the Fed alone. Biden didn't say much about the Fed. Harris didn't say much about the Fed. Trump is going to criticize the Fed every step of the way. And you can see it in Jay Powell's face. He's not real happy about it. He doesn't want to do it. They believe that they've got this thing licked, and they've got a whole new set of variables coming. They say another point of rate cuts next year. I don't believe that for a minute. That's going to change. I'm curious to see if they cut again, if they even cut rates next month. Remember, we were supposed to come off about another half point after this meeting. So they're going to meet in December. They're either going to cut rates or stand pat. I'll bet you $50 they stand pat and wait and see what's going to happen. It is Arshad Khan, Trump versus Powell. Absolutely, absolutely. All right, guys, well, we were trying to get in here and hit this one really quick. The low was 72.05. That was our entry. It was somewhere in there. Yeah, 72.05. We didn't get filled. That's typical with crude oil this time of day. Very thin markets. Excuse me. A lot of questions on gold in the live chat here. So I'm going to go ahead and give you my analysis on it. I do want to show you this, though, and I'm not trying to put lipstick on a pig. We were short from right there at 97. The idea was 97 and between 97 and 700 was going to give us a little bit of resistance. Broke through. We really didn't get much positive. Our sellers stepped in front of 2,700, protected it, but once it was gone, it was gone. Your first loss is your best. If we don't cut that thing off at 2,745, we've already bled another $5. You can't do that. Listen, when your trades don't work, you got to get out, and that's the difference between winners and losers. There's a lot of winners out there, and there's a lot of losers, and a lot of the losers are very good traders, very good technicians. They just can't take a loss. Take the loss. Take the loss. Take the loss. Very important. Look, we're going to go right up to 27.10. So the big question was about gold. You could sell right up there. I would say that's a pretty safe sell. Let's go ahead and break all this stuff down. That's a 1-minute chart. Let's go ahead and break what we think gold's going to do down, because everybody's wondering realistically what this thing can do. You're in a bullish uptrend, no question about it. The uptrend's pure as day. Did yesterday's dip, was that a buying opportunity? Clearly it was. We showed you these Fibonacci's here that we had put out there earlier this week. I take no credit for being able to call the bottom of anything because we didn't do very well here scalping. We didn't do very well here scalping, but we essentially came within $1 a call on the bottom there. So we're down there about 26.42, and now we're up to 27.08. So that's about a $60 move. So we start thinking about, okay, what's going to happen? That's confirmation to me that you're still very much in a gold bull market. And as you get more rate cuts and things of that nature, you're probably going to see gold move higher. Now, there's a couple of market drivers that we really need to be aware of. And the first one's geopolitical stability. There's already been talks that the Russia-Ukraine situation's winding down. Trump's been outspoken about ending that and ending it quickly. And we saw news releases yesterday that Putin was ready to meet and talked a little bit of shop. As soon as the geopolitical stuff ends, the wars end, you're set up for a correction in gold. You really are. Now, are we overbought right now? I don't believe so. And the reason why is, and this is going to be a third-grade technical analysis, but I just have to show you. I have to tell you what I think. All this work, all this milling around down here at 1,900, then we finally got the break above 2,000. That was historic. Then we got a pullback right there. We got a little bit of compression around 25. We nailed the 2750 area, and we're still going. In my view, there's probably one top side target that most of the big guys have, most of these institutional investors have, and that is right up there. It's right up there at 3,000. So to answer your question, are we going to 2,900? You're going to 3,000. So we'll look to scalp right in front of that level. I'm not really too interested in taking a position against this market until we get something a little more concrete. But scalping in front of 3,000 will be pretty good to the short. But as far as where do I think gold's going, 3,000, and I think everybody can see that that's really the trend. Is there anything that can stop this rally? Yeah, there's a couple of things. Number one, end of the wars. Number two, the BRICS countries, the new BRICS currency. A lot of talk about that being 40% backed by gold. Saudi Arabia's bought a tremendous amount of gold. Russia buys gold. China buys a huge, staggering amounts of gold. So if, in fact, those tariffs are going to be aimed at the BRICS countries from the Trump administration, which is what he says he's going to do right off the bat, if you don't do business in dollars, we're 100% tariffs across the board, that will stop the BRICS currency in its tracks for a lot of reasons. So if you're dissolving wars and you're putting the BRICS currency on the back burner, That speaks towards gold coming off big. Does it happen before we hit 3,000? No. No, I think we go right up there probably later this month. Not later this month, but probably by the end of the year. I would say 3,000. This last 2 weeks, in my view, is just sort of indicative of election uncertainty. You sort of had that hammer formation. You saw the monster sell-off yesterday, and now you've got the big rally today of almost 2%. I mean, we're still very much in a bull market. Until those fundamentals change, you're not going to see gold crash $500 or $600 like a lot of folks believe. That's my own opinion. You can take it for what it's worth. All right, guys. Well, we didn't do very well here trading live here today. Oh, this trade's doing well, this 9 EMA crossover. Remember, 9 EMA, we did a video on it. This is a 920 with RSI confirmation. The reason why I did it on a 5-minute chart is because I wanted 5-minute increments from the Fed meeting, from the Fed announcements at noon my time to the end of the presser. So I knew we were going to get about, 12 bars, 12 5-minute bars. And that's plenty good for us to really build a conclusion. And you see right there, that one's in the money. So the leverage was a little bit different. Let's just go over what we did here today. That one's up 350. If we wanted to crush it, we could. Account history, what do we got right there? We had some scalping earlier today. Yeah, right there. There was our close. So something like that, 422. Taking that loss on that gold trade still keeps you alive. Keeps you alive to walk away from the day profitable. And if you didn't take that loss, you're getting really smoked here. Remember, our 1-minute chart shows us exactly what happens right now. And we got out right down there. You can't run against the market, guys. Once it breaks against you, you just got to get out. That's the bottom line. All right, everybody, I want to thank you for joining me here for Fomc Live. I have a lot of fun covering those. I'm very critical about what happened here today. I think that the Fed is in full CYA mode, and the feeling I got from Jerome Powell was, hey, we got this under control, and now we're going to change regimes? Well, we don't know what we're going to do. Well, would you consider stepping down? No. Can the new president fire you? No, he can't. Very confrontational. This is going to be a battle that starts after January 20th. The first thing Trump's going to do is he's going to go after the Fed with his dukes up. And if they don't keep cutting rates, I'm curious to see what happens to these markets. Who knows? That's what being a trader is all about, guys. Figuring out what we're going to do no matter what happens. Thanks, Bryn. All right, everybody, I'm going to go ahead and sign off here for a few hours. We'll be back tomorrow. I'm going to adjust the schedule a little bit. We'll be up and running probably at about 8 a.m. my time so we can do a little bit of scalping. We'll recap the week that was. There was a lot that happened this week. It says you live decades and nothing happens, and then you live a few days and decades happen. That's exactly what happened this week. A lot of big surprises, a lot going on. If you're out there, trade it safe. Full disclosure, I haven't made a trade this week. Yeah, too risky for me, but a lot of you made some money. So if you made some money this week, 50% of it goes in your pocket. I don't care if you made $1,000, put $500 in your pocket, take it home. If you made a profit this week, you did very well. It won't always be this difficult. It won't always be this difficult. All right, everybody, you guys have a fantastic evening. If you're following me in Europe and if you're in the U.S., enjoy your afternoon. And if you're overseas, get some sleep. We're back and going tomorrow. All right, everybody, have a great day, and we'll check it out later.